Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about UPL, a very interesting play on the agrochemical sector and in the agricultural space. So let's understand whether it is a big buy at these prices or should you avoid it. Let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I start with analysis of UPL, here's a small request that kindly support me through Patreon. And once you do that, I'll be able to make better videos on YouTube. And once I'll have 100 patrons, you'll be able to get a free, you can say, course on investments for no additional cost on YouTube here. So kindly go to my Patreon website. The link is in the description. Now about UPL, the company was established in 1969, and they provide agrochemical and phosphorus products for companies all across the globe and for the agricultural sector. It is the top brand in this segment and is a global brand. They also produce industrial and specialty chemicals, and they have grown in leaps and bounds over the last 10 years. So I've watched it grow from a 400 crore market cap company to now a 22,000 crore market cap company, and it has diversified into many segments of agrochemicals. It is a multinational firm spread over a number of countries globally. If you look at the financials of the company, then it has been extremely robust. The sales grew by around 83% year on year on the December quarter, and the profit growth was exceptional on the consolidated basis at 78%. The growth was around 78%. There is a working capital debt with the UPL, but not very huge, and very high institutional holding is in the company. The return on equity is 15%, which is very reasonable considering many of the companies in this sector are churning out ROE of less than 10%, whereas the operating profit margin is around 18%, which is again higher than the industry average. And that's why it is called one of the leaders in this segment, and in this niche space, it is perhaps the best. If we talk about the performance of the stock, then stock is at a 5-year low. It had gone below 300, but has now recovered above 300, 320 rupees. But usually it used to trade between 550 to 800 rupees earlier before this fall happened. So the fall has been excruciatingly painful for UPL investors. But these are very interesting levels to get into if the condition, if the economy comes out of this trouble whenever it happens. Also, whenever the rural economy comes back into picture, this stock would be the front runner along with Escort. So this is a big play on the rural economy. So one has to take that into consideration. The numbers have been extremely robust because the global you can say business has been doing well, although the Indian business has not been doing that well. The return ratios, as I just mentioned, is pretty good compared to the industry, and it has been consistently going up. So there has been no letting off with the return ratios. The sales numbers have been strong. The promoter holding is low, and that is a cause for concern. But if we look deep into the shareholding pattern, then individual holding is high, and some of the individuals are related to the promoters itself. It feels like that they are high net worth individuals in themselves. Plus, there is high institutional holdings with FIIs, DIIs, and mutual funds invested into the company, even at these levels. So that compensates for the low promoter holding. The debt is high, but it looks like looking at their annual report and everything else that these are working capital debt. But really, I believe that being an agrochemical company and catering to the agricultural space, the rural space, the company should be having very low to no debt. So this is a cause for concern, yes. But the dividend payout is good, and the valuations are extremely reasonable at the moment. So why I believe it is a buy on decline? It is a market leader in its space. So in terms of you can say any other company, there's Shada Cropchem. There are other companies in the same division which are unlisted, but UPL fits the bill, and they are the leaders in this space. It is a global agrochemical company, and not like other companies which are only serving the Indian, you can the Indian space, and that helps. Although it is extremely detrimental at this point of time because of the situation that is happening globally, and probably the shutdown is not helping. But whenever things recover on the European front, the stock will again continue to do well, and especially in the South American region, the stock is big, the company is big. So all these things taken into consideration, these are attractive levels to get into, and perhaps have a 3 4 year time frame, and the company would recover. But at this point of time, you never know that how long this will continue. So probably do an SIP into the stock. Will outperform as rural economy and global economy recover. So not only in rural India things need to mend and things need to get better, but globally as well, with their main operations in South America and Europe, those countries need to again recover big time from these setbacks of the current situation that is happening there. And then you would see UPL even exporting pretty big amount, and doing really well on the consolidated basis. One thing or one line of a silver lining that came out just before the pandemic was in January, when the tractor numbers came in, and they were very good, and we saw the Mahindra and Escorts tractor numbers, which were well above expectations, and that really tells you that the rural economy was coming back, pretty vehemently coming back into picture, and probably stocks which are catering to the rural India would continue to do well. So these are extremely good opportunities to get into the stock, and perhaps whenever things get back to normalcy in September, October, or anywhere by the end of the year, FY22 could be very big for companies like UPL. So but next 6 months would be very interesting to get into the stock. Attractive valuations at only 18 19 times the earnings, but current earnings, very attractive. Normally it used to trade at between 25 and 30 times earning, and currently it is valued only zero point 0.6 times sales. So it's not only one time sales at the moment, and it is a large, you can say, mid cap company. So it's not that it is a very micro cap company or this and that. So in that regard, trading at only zero point 0.6 times sales is very very cheap. So if you look at the technicals of the company, the strong support lies between 250 and 270 levels. The 200 DMA, as I said, that normally 550, 560 would used to be very strong supports. The 200 DMA is around 550. The stock has fallen vertically since February, as I mentioned, in the last 1 month. So reversal has taken place, and you need to look for better means. Numbers to get into the company, but these are very good levels to get into. The long term stop loss can be maintained at around 250 rupees. It can see further downside from here, but what you need to do is buy as an SIP, and don't look at the prices at the moment, and probably have a 2 3 year time frame. So the best strategy to do is buy on major declines. Whenever major declines of 4 5% come in, you buy 10 15% of the stock. Keep track of numbers every quarter, and have a good 5 6 year time frame, and you'll get multiple return. It can easily be 2 3x from these levels. So have that point in mind. But next 1 year could be tough, and have less than 5% exposure to the stock. So this was my video on UPL. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.